Welcome to our series of recap videos and to our introduction to accounting course. Welcome back, ladies and gentlemen. And this section we are going to focus our attention on the linkages of the three financial statements. We are going to go through them using the following scenario, the assumptions as we have stated them here. And these are the ones we are going to use, these 6 lines. And we are going to seek to use that to explain how the 3 statements link together. All of this will be on the backdrop of the explanations I've given earlier on based on income statement lines, balance sheet, and cash flow. So let's dig in together and take the first. So assuming we make a sale of 10,000 on cash, how will this impact these 3 statements? So if we make sales of 10,000, you can see it has got 3 impacts. All the statements are impacted here, and we see that our revenue will shoot by 10,000. Yes, and at this point, once we don't have any expense to deduct from either cost of sale, SG&A, or any notional cost like depreciation, we don't have any interest expense to pay, we don't have any taxes. At this level, you see that the revenue becomes the net income. And this net income, if we take out the preference dividend, which we haven't at this point, will feed into our retained earnings line, which is our surplus cash. So at this point, everything feeds down because no expense has been incurred. Now, when that happens, the net income line will also feed the cash flow line. And then again, once there are no notional costs, depreciation and deferred taxes, and then also there are no working capital adjustments, which means that there are no sales made on credit or no expenses on credit and no inventory movement and whatnot. The working capital is flat at this point. So you can see that the impact of an increase in revenue is to increase net profit and then increase cash if the revenue was made on cash basis. So once the net income is 10,000 and there are no adjustment to notional costs, then your cash will be equal to your profit at this level, because you have made a sale and no expense has been deducted, and also the sale was made on cash basis. So your cash balance generated during the year, you don't have any opening, so that's 0, but during the year you generated 10,000, and that feeds back into your balance sheet as the cash. So the asset side of the balance sheet, you have a cash and cash equivalent of 10,000, and then the liability side of your balance sheet will have a retained earnings. Liability and equity side will have the retained earnings of 10,000, that being your surplus. So your balance sheet still balances, and you can see that that is true. 10,000 here as our total assets, and 10,000 there as our total liabilities and equity. So let's go on to the second. Assuming we buy inventory, so the sales made actually was an inventory of 4,000 cost to us, which we sold. We would see that the cost of sales would reduce the revenue by that expense. So with that, our net profit will further reduce by the 4,000 and giving us 6,000. Then and again, the net income here after any dividend payment, which we haven't made any at this point, will feed into your surplus line, having 6,000 retained earnings, or your surplus having 6,000. And then this net income line in the income statement will also feed your cash flow, which will also be 6,000. There are no notional costs, depreciation, and deferred income impact on this yet. So nothing. And at this point, we are not assuming any credit purchases or credit sales. So the working capital is also flat. What it means is that our net profit again will be equal to our cash, which will then feed our balance sheet, and our surplus being 6,000 down there, and our cash also being 6,000 down here, and our balance sheet still balances. If we go on and say that let's assume that we charge operating expense of 2,500, this also means that our profit will further reduce by the 2,500, making us get a profit of 3,500. Then and again, this 3,500 after any preferred share dividend on any common dividend paid will remain our retained earnings or our surplus. And our surplus will also, our net income will also feed our cash flow and also reduce our cash by that much to 3,500, and we'll have a cash balance of 3,500 feeding back into our balance sheet with a cash of 3,500, and our retained earnings also giving us 3,500, and therefore our balance sheet will balance. Let us go on to the fourth one. So if we assume that 1,005 of our sales was made on credit, see the impact. Let me show it again. You realize that it doesn't impact any income statement line here, because the sales made here is recorded whether it is made on credit or not. So once you show the impact here, it is only going to affect the balance sheet and the cash flow. This still remains the same, but when we come to the cash flow, you realize that we have a net income of 3,500 feeding the operating activity section of the cash flow, 3,500, but then no notional charges or notional costs here at this point, which is depreciation and deferred taxes, but there is an impact on working capital. What that means is that we made a sale of 10,000, and in this 10,000, 1,005 of them were sold on credit. So 1,005 cash wasn't paid. So when we are making our adjustment to this net profit line here, net income line in our cash flow, we need to adjust for the changes in working capital. In this, at this level, it's only receivables. So we need to deduct the 1,500 from our net income of 3,500 to get the actual cash we have received, actual cash. What it means is that we made a sale in essence of 8,500 cash. We paid 4,000 out cash, right, giving us 4,500 remaining, and we paid 2,500 out as cash, giving us what? 2,000, which is showing. And that is what this seeks to do. It seeks to split the cash element or net income element and tell you that, okay, within this net income of 3,500, 1,005 of it must be removed so that the real cash we have received is 2,000. And then our cash balance becomes 2,000. Our receivable, which is our debtors, people who owe us, will still be 1,500. It is something we have to collect, and so it's also an asset. But then you realize that the liability section will also show only the equity or the retained earnings of 3,500, and our balance sheet still balances. Now let me explain that section again. The cash here is split, the profit is split between what was generated out of cash and what wasn't. And we realize that the working capital, we had made credit sale, so we need to reduce the net income line here to adjust so that we get the actual cash flow from it. So that is how this impacts it. Now let's move on to inventory. If we assume that we have 800 of inventory in stock, you will see that there is still no impact in the income statement here. We are still showing a profit of 3,500, but when we come to the cash flow, the net income feeds here, this net income line here will feed this line, and so we need to make an adjustment. The changes in working capital is showing 2,300. Please look at the workings here. You can see that our previous balance we had 0, but the current one we have receivables of sales not paid by cash 1,500. We also have inventory that remains unsold, so it means that that cash element has also not been released yet to us. So we have 2,300 as working capital adjustment to deduct from our net income to show the actual cash balance we have in our cash flow, and that is also split. So this 1,002 will feed back here, and we will show our receivables we are yet to collect, and we will show our inventory also being 800. Now the calculation of the working capital here is previous balance minus current balance. The previous balance was 0, the current balance is 2,300. So previous minus current will give us negative 2,300, and that is here to reduce the net income to give us the actual cash of 1,002 to feed our balance sheet. Now if we go on further and say that we also assume that 1,000 of the operating expenses remains unpaid, which means that this SG&A we have charged here, in reality 1,000 of it has not been paid as cash. So it means that we have also gotten some inflows in terms of cash. So this and that will give us 2,000. The 1,500 and 800 will give us 2,300. Minus this 1,000 will give us a balance of 1,003. So what is here is that we have 1,005 of our cash locked. We have 800 of our cash locked to inventory, but then we have charged some 1,000 we haven't actually paid, so that becomes an inflow. So 1,005 outflow plus 800 outflow, because we haven't received that cash yet, and this cash we have expensed but we haven't paid, that is technically an inflow. So we get a balance of 1,003. So what that means is that this same 3,500 here, we need to adjust for only 1,003 because we have our 2,003 locked up, and we have also locked other people's monies by 1,000. So the net effect is that we have only our money 1,003 locked up, and that will reduce the net income balance to give us the real cash balance of 2,300, which will feed the balance sheet cash by 2,200. And then when you come to receivables, we show that by 1,005 we still have 800 in inventory, and we have 1,000 in accounts payable to pay. That is, we owe our clients this much to pay. So that is how these revenue, cost of sale, SG&A impact, and especially with the introduction of the working capital, that can be a bit tricky, but I'm not sure it will be too much for you to handle. What that we are saying is everything are current assets less current liabilities. So we have these two as being our current assets, then you less this current liability, that's the payable, then you will get your actual balance here. And remember, it is previous balance minus current balance to get the working capital balance to charge to your cash flow statement. Thank you.